Hey traders, this is Blake Morrow with Trader Summit, and I have with me, and it's been way too long, but I have Mr. Benn Maldonado, an individual and independent investor in the markets, but somebody I like to listen to because he offers some great advice moving forward. So how you doing, Ben? Good to see you again.
Doing great, Blake. How are you?
Great. You know, you've been on the Trader Summit before, but for the last couple of years, you've spent some time on different broadcasts, like with one of my colleagues, Dale Pinkert, and I've loved always listening to what you had to say. And as we turn the page, for some of us, it's going to be a good page to turn, out of 2022 and into 2023. I kind of want to get your views as we head into this next year. It's been a rough ride for a lot of investors this year, hasn't it been?
Yeah, and unfortunately, if the cycles play out next year, it's not going to get any easier, and things may get a little more intense. The good news is that, as morning follows night and spring follows winter, and that's kind of what we're looking at. Is we got to get through this winter time frame to get to the next bull market where we can buy risk and sit back and just let it rip.
Yeah, and when you look at like the markets and you take a step back, I was actually just having this discussion with the community I trade with, and talking about the last 13 years in the market, this bull market we've had, which has been engineered by central banks for of course there's been some great cutting edge technology developments with electric cars and a lot of energy, but all in all, a lot of the bull market we've seen the last 13 years have been engineered by central banks, and so there's got to be consequences to that, right? And are we living through that right now?
Absolutely. And I think one of the things that on Twitter that I've done, and also in the talks that I've given, as you mentioned, is to try and get people to understand that that's over, right? We're in a new regime, that the easy money is over. And so if you're still investing with that thesis behind you, you're going to suffer. And, we've seen it this year. Bonds have been punished. Tech has been punished. Crypto, if you've been in crypto, you've gotten killed. So you really have to get rid of your recency bias and say what just happened and what was working is not going to work going forward. So what is going to work, and what can we do to protect our capital and then grow it? And that's the big thing. Your point about the last 13 years are going to be very different than the 13 years going forward.
Yeah, and gosh, I look at people like yourself and myself over the age of 50, and the generation in front of us and the half generation in front of us as well. People that are baby booming and we're going into retirement, and it's a big segment, and they hold a lot of the wealth. And they've ridden a pretty damn good bull market over the last 30 years, haven't they?
Absolutely. And hopefully, they booked some gains and, put some cash on the books, because again, I'm not saying it's the end of the world, but it's the end of a cycle and the start of a new cycle. And that's always going to create opportunities, right?
Let's talk about some of those cycles. The last time we spoke, which you guys can always go back and listen to, we met up in June. You talked about the 400-year epic cycle, and I know we don't have to go through that and rehash it, but what type of risks are we coming into, going into 2023 that you see that's a clear and present danger immediately going into this next year?
Yeah, so in 2023, I think the themes that are going to be most prevalent are, number one is war and escalation of war. So whether that manifests as an intensification of the war between Russia and Ukraine, or a widening of that war, or new wars starting, I don't know, but the energy and the cycles are supportive of an escalation of war. So we have to know that what does well in times of war, what does poorly in times of war, so that you can position and prepare yourselves for that likelihood.
Yeah.
The obvious things that come to mind, the beneficiaries of uncertainty are things like precious metals. And Blake, I mean, I know I listen to this show every morning that you guys do. which is a fantastic show, by the way.
Thank you.
You guys have been all over the precious metals, right? Gold and silver. They're already starting to act well, even before this war escalation sort of theme is coming in. Because I think what a lot of traders have learned is that we had raging inflation last year, or all of 2022, and gold and silver really didn't do anything. Because people thought, oh, I go into gold and silver, it protects me from inflation long term, which it does, but in the short run, it didn't do anything for them. So the key thing there is gold and silver react more to, and precious metals react more to, uncertainty. And so with seeing them kick up in the last month or two, make their lows and begin to sort of begin uptrends, on bigger time frames too, tells me that the market participants, the ones in the know, are starting to pick up on the fact that there's going to be some lack of confidence in government, lack of confidence in the system, and they're beginning to shift some of that money into precious metals.
I know we're getting past midterms, and there's been a lot of I don't want to say civil unrest, but there's been a lot of question marks to certain regional elections, and I have to imagine that that's just going to intensify as we head into the next couple of years, as we head into the general election for presidents, and I can't imagine it subsiding right now.
Blake, you hit on another theme. Civil unrest is definitely going to be on the rise next year. And that's part of a thing of this theme of separation, right? Not only separations, which we're seeing on a global scale, right? Separations of nations. People are sort of picking sides. What side are you going to be on? You got China, you got Iran, you got Russia. They're kind of forming a bloc. You got the US, you got Europe, and we have some allies that are coming with us. So not only are you seeing it on a nation level, a national level, where we're seeing these splits, but we're also seeing it within countries, where here in the United States, you've got states where they want to secede. They don't want to have anything to do with the other states that don't agree with them. I read somewhere where there's counties in Oregon that are petitioning to secede and join Idaho because their politics doesn't agree with the statewide politics that controls the Oregon state. So we're going to continue to see this separation. And part of that is going to be civil unrest. We hope it doesn't turn violent, but ultimately, I've seen some predictions from people where they say, the United States is going to break up into smaller countries and smaller coalitions of states, where like the Floridas and the Texas that have certain politics go together, and the Californias and New Yorks and Illinois go together. So I think we're going to see that trend continue. We have to hope it doesn't turn violent, but civil unrest is certainly going to be on the rise.
And I'm going to assume your hedge against that would be naturally gold, right? And if you think about that from and I think about it from a trader's perspective, this last year, I think one of the things that really hurt gold was the insatiable rally that we've seen in the dollar. But, taking a step back and then looking in the rearview mirror, you're like, well, based on what the dollar did, gold really did hold up fairly well. I mean, pretty considering. Well. So, if the dollar comes under pressure because social unrest, let's just say, the gold might be that natural beneficiary. So
the other thing, Blake, that I encourage people to do is, one of the other themes that you and I talked about in June was the comparison between now and the 70s. And that kind of continues, right? That we're experiencing similar cycles that we did back in the 70s, with oil issues and international political issues, as well as internal politics. And in that period, in the late 70s, the dollar and gold actually went up together. So the traditional linkage, as you said, which we've seen this year, and gold fight that a little bit, that correlation may not hold next year, right? Because I do think if we see escalation on a global level of war, money's going to come into the dollar, because the capital always looks for the safest place to go. And even though we have a bunch of problems here and we have our own issues, it's still the safest place for capital.
Yeah. That makes sense. So what other we got civil unrest, we got geopolitical risks. What else is really kind of eating at you where it keeps you up at night type of thing?
I think the volatility, which has been suppressed recently, is going to be off the charts next year.
Wow.
It's going to be a trader's market, so guys like you will do really well, but the people that try and trend trade, follow extreme moves are going to get crushed.
Yeah.
Because the whipsaws and the volatility is going to be really, really high if these sort of events play out next year. Like probabilities favor they will. It's never a guarantee, but I think we're going to have some extreme volatility.
That makes a ton of sense. I know you're not an economist by trade per se, but do you have any thoughts about inflation this next year? Because this year has been all about peak inflation, and it may roll over, and you can count the reasons why inflation has been strong, and then you could say, well, it's going to subside because of China reopening and supply chains going back to normal, and it's an anomaly because it was induced by the COVID lockdowns. There's all sorts of arguments, but in your view, based on the research you do you have any feeling for what inflation might do going into this next year?
I think inflation is going to confuse a lot of people because, as you said, we're starting to see it come down. And so what may happen is similar to what happened in the 70s, where they make a policy mistake, right? They see inflation coming down, so they take their foot off the brake. Whether maybe they don't cut rates, but maybe they stop raising rates too soon. And if that happens, inflation is going to be worse. So I keep saying that this cycle for the next 3 to 4 years is going to be characterized by shortages and economic limitations. Now, what does that mean? Shortages, we see it all over the place, right? You see it in the grocery store. You see it if you try to buy, furniture, or if you tried to buy something during the pandemic, like a refrigerator or a car. And it's sort of moving throughout the economy. Like they fix it in one spot and then it appears somewhere else. Like the baby formula was a huge problem.
Right.
Now you're not hearing about baby formula, but it's children's medicine was something I saw today. Like there's shortages of children's medication. There's shortages of antibiotics. I read about that a few weeks ago. So just a simple supply and demand thing. When you have less supply of something and demand stays the same, prices rise. So I don't see how we're going to have that in the battle about inflation is over if for the next 3 years we're going to be experiencing shortages and limitations in the economy and in the global economy, not just in the United States.
Yeah.
I mean, look at oil. Oil's a perfect example, right? They keep talking about, demand's going to get crushed because the economy is going to slow. But the issue there is supply. It's not demand. The supply hasn't been invested in for years. There's been a lack of investment because of government policy, this sort of anti-fossil fuel policies. So you're just not going to see oil at $30 a barrel anytime soon. It's more likely you're going to see it $80 to $90 a barrel.
Yeah.
Which means inflation is going to stay higher for longer.
Interesting. Well, as we kind of wrap up our conversation, I really want to dig deeper this first quarter of this next year, kind of looking, maybe at some of the data that you've extracted and how you're viewing things. But where are you, Ben, as an individual investor, as somebody that's managing your own money, but trying to figure out the best place to be? What's your best ideas going into the beginning of 2023? Where should we as investors be looking to find some trends?
I think most investors should be in cash. That's the safest place to be. It's the place where when and if we get some sort of market dislocation and a washout, you'll have the money available, the funds and the liquidity available to take advantage of that. Because I do think we're going to see some sort of washout low next year, whether it's, April, May timeframe or June, July. I'm not 100% sure yet, but cyclically, that's kind of the time frame I'm looking at. Like we're going to have some kind of event that creates a low, a good tradable low where we may have, like a 12 to 18 month bounce. I mean, again, go back and look at the 70s. We had sharp downs and then sharp rallies and then sharp downs and then sharp rallies. And this may be what we're going to be in store for. So cash, I think, is one really good thing. As we discussed, precious metals, I think, is another good thing to have some, preferably the physical kind. But if not, maybe the ETFs, you have some exposure there. If you're really aggressive, you can short risk. When you get into if we get bounces, I know you were hoping and praying to get a 4,200 bounce to short.
Yeah.
Unfortunately, we didn't get that. But looking at finding a good resistance point in markets and shorting risk into what could be a very volatile period. So those are the types of things I look at. For most people, it would be get to cash as much as you can and be ready.
Yeah. I'm wondering, and I don't know if you trade much on the bond market, but this year has been categorically just the worst for any portfolio manager, as the typical, typical, equity to bond, mix has just been atrocious, and portfolio managers have underperformed grossly as a result. But do you have any feelings on the bond markets and where yields are going to go?
I still think there's a lot more to go in terms of the downside in the bond market.
Wow.
We've had a nice rally off the lows.
Yeah.
But we're just, if you look at a longer term chart, we're just backing up right into previous resistance and previous support. So, and again, if the inflation theory that I'm working off of and the cycles talking about the shortages are present, I just don't see how we're going to have, low rates again, like we saw in the last 13 years. There's going to have to be that inflation premium built in. The Fed's going to have to keep rates higher for longer. They may not go super high like they need to, but they're still going to have to keep them higher for longer. So
yeah,
that's going to be trouble. The other thing, Blake, I'm not a fundamental guy, but I do know about fundamentals and look at them. If you look at have you looked at the S&P earnings estimates for next year? Like
they're still unreasonably high.
They're still high, but even taking the estimates, I just checked it. I was looking at. They said they're looking at basically 232.53 is the estimate right now. So $232.53. If you put a 15 multiple on it, which is a generous multiple, by the way, 15, it puts us at SPX 3488. If earnings get crushed and that number has to come down and multiples get compressed more, where do we go? 3,000 less? I mean, that's the kind of thing you got to think about when you're saying, oh, maybe I should buy some stocks here. And I don't know if it's like a suspended animation right now, but it feels like everybody has their head buried in the sand about that earnings are going to be okay and that this is going to be fine. And I don't see it. I mean, FedEx came out again and was cutting CapEx with, they released last night and talking about how bad things were. And I always talk to the people at the businesses I go to. And I was at FedEx the other day. I said, how's things? And, over the summer, they said it was terrible. I said, how's Christmas going? They said, Christmas has actually been good. It's been fairly busy. They said, but overall volumes are still lower. So,
and that's probably going to be a common theme, moving forward. And I always like to remind people, as from an investing point of view, during times like this, you want to find companies that are actually producing and making money, that maybe even can offer some sort of dividend. But some of the speculative stuff is probably going to go out the window for a while.
The other thing I wanted to talk with you about, Blake, is every financial crisis that we've seen, sort of economic and financial crisis, has been caused by excess debt and collateral, right? The collateral starts to come into question. And when you have high indebtedness and the collateral begins to come into question, that's when the panic starts. That's when the meltdown starts. So I said, if that's true, which it is, go back and look at history, whether it was, the mortgages in 2007, 2008, the tech stocks and VC money in 2000. It's always about the debt and the money that's built up. And then the banks have too much exposure to it. And then they start questioning the collateral, or the collateral drops. And then that negative spiral starts. Where I went and looked and I said, where has the most debt been created in this last cycle? So say after the great financial crisis, where's been the largest growth in debt? The answer is it's sovereign debt. So it's debt by governments. So this next cycle, I think what we have to be looking at is, do we start seeing cracks in sovereign governments and sovereign debt? Because we know what happens when that begins to happen. Then everything starts teetering, right?
Yeah.
Everything starts, wobbling. It's also a reason why we could see even more dollar strength next year. Because if that comes to pass, money's going to rush into the dollar.
Yeah, it's all rushed back into the dollar. It becomes a liquidity dollar liquidity issue. A lot of things to think about, Ben. And I love meeting with you. But let's try to end on a positive note. So if I'm a bull, I'm going to put my money.
You're going to put your money in cash, and then you're going to be ready to deploy it in next summer. In the summer of 2023.
And in gold.
And in gold and silver. Yep. Gold, silver. If you have to invest it now, it's gold and silver, oil and gas, US dollar.
All right. Well, Ben, I want to wish you a happy holidays to you and your family. And I really look forward to having a discussion with you maybe the first couple of months of 2023.
Same to you, Blake, and your family. I really enjoy your work, and I hope 2023 is a fantastic year for all of us, and we can take advantage of the big swings.
Sounds great. All right. We'll talk to you soon.
Take care, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.